How about this pain-free trade going up to our 127, stopping right on a dime and turning around? The other day, I shared a massive trading opportunity and it didn't disappoint, ripping over 100 pips in our favor right away. But here's the interesting part. It wasn't just about finding the trade, it was about knowing exactly where the move was likely to end. And today, I'm gonna share with you our step-by-step analysis that we did in the live trading room and show you just exactly how we dialed in on that very specific profit target, as well as teach you a trading strategy. Then at the end, if you can hold on that long, I'm gonna show you what you can do if you still wanna catch the next 100 plus pip leg of the move without making the same mistake that traps many traders into becoming suckers by buying at the worst possible time. Let's hop in. If you are a aggressive trend continuation trader, right? Remember we had two zones. We had the lower kill zone here. We had the previous level of resistance turn support here. If you're an aggressive trend continuation trader, here is your entry. Higher high, higher close candle. You can mark this up a few ways, right? The biggest level we were looking for was 219s. Maybe you're not shooting for 219. So while I put stops on, let me know of any ideas you can have that may give you a target projection up here. Stop loss will be right here if you're taking this higher high, higher close entry. Devin said AB equals CD pattern. Very nice. Yep. Equal measured move. So here's your A to B right there. Let's copy and paste that. That's going to be your B to C. Oh, look at that, Devin. Almost right exactly at our 219 even handle. How about that? Any other ideas for targets? What would we use to project an extension? There we go, Fibonacci extension. It's in the name, guys. Fibonacci extension tool. Swing low of our A, swing high of our B. Back down, and you see we have a 1618, we have a 127 if you're looking for a kind of a shorter term mark right here. That's the first extension we would expect price to extend to. And then obviously the 1618 right here. Now, you have this situation right here. We have three things happening, right? You have a 219 even handle. You have an AB equals CD up here. You have a 1618 extension right there. The question is, which of these three would you take? Greed is one of the cardinal sins of trading. So many traders have this mindset that they need to catch every single pip of the move. They don't want to leave anything on the table. And that way of thinking often leads to poor decisions. But professional traders think a little differently. Instead of trying to squeeze every last dollar out of the trade, we're focused on finding that sweet spot where we can maximize our profit while minimizing our risk. That's the goal. And here's exactly what I mean. Where would you place targets at? The 1618 Fibonacci extension, the AB equals CD pattern, or the 219 even handle? What made you choose the 1618, Steve? Steve says because it's below the even handle number in the first ring. So it would be the less riskiest of the options. Would that be correct? Yeah. So and that was the point I was trying to make, where it's like you're looking at a move from here, all the way up to 219 even, right? That is 224 pips. Your 1618 is a little bit below that. That's at 203 pips. When you're moving 200 pips, is it worth putting yourself at an area that has it's not a bad area, but just statistically, it has a lower chance of getting hit than an area before it for 24 extra pips when you're making 200? Is it worth that risk? No, I would do exactly what Steve said. Yeah, 1618, right? Can the 219 even handle get hit? Yeah. Can that AB equals CD get hit? Yeah. Can the 1618 be proven as a level of kind of like looked at as like a resistance level? Yeah, why would I want to fight that? Plus, we know that that 219 was taken from a structure level from 2008, and structure levels work in ranges, right? So what we're trying to do here is we're trying to use our target projection tools to kind of narrow down that range. So yeah, I think if you're shooting for an extra 24 pips when you can make 200 and be a little bit safer, I think you take your 200. That is the smart trading decision, knowing when not to be greedy. Because the last thing you want is you want this trade rolling up in your favor, 220 pips, and then turning around and you getting stopped out for like 100 or something like that. Not negative 100, but like 100 in profit. All because you got a little bit greedy for 24 pips. Trust me, and I say this from personal experience, it's not worth it. So real quick, just take a look at the risk reward on both of these. I know some questions are coming through. Just again, higher high, higher close entry right there. 1 ATR stop right there. I don't think we need to measure out the second ATR, but you could if you want. If you're doing a target one at the 127, that's good money right there. You still got more than a 1-to-1. And then again, if you're looking for the 1618 as your secondary target, even better risk reward. Bada boom, bada bang. Again, we broke this thing down. In this next part of our analysis, we're going to take a look at a secondary way to enter the trade using one of my favorite and fairly rare trading techniques. Now, since I know many of you guys aren't familiar with it, I do want to take a minute or so to teach you the strategy and explain exactly how it works. Then we'll hop onto the charts. That way it actually makes sense. If the market were to do this, here's my question for you. If the market were to go up here, could you still look for a trend continuation play? This is a tricky one, and this is going to be one where I always categorize this strategy as saying it is one where the rules don't actually make sense, but they kind of make sense. This is technically a violation of our trend, right? Because if we are looking at this as our new structure low, our outside return, our new structure low, we know that if the outside return is violated, then boom, the trend is violated, right? So this is where the dilemma comes in, because you have a violation of trend. Therefore, if you have a violation of your bearish trend, you should no longer be looking to get bearish. But on your higher time frame, going back to the hourly, does a move right here violate the trend at all? No, right? And this was the interesting thing with day trading, because you see so many of those kind of micro trends, right? The trends within the trends within the trends, that you're going to get those ebbs and flows, which are good for day trading. But you're also going to get these things where sometimes they are violated on that lower time frame, but not violated on your higher time frame. So this is where the Fibonacci inversion tactic came in. And here's what you would do. Take my Fibonacci extension tool, invert it from my low to that outside return and back down. And the key trigger for me, right, was the 618 or 1618, excuse me. I then took my Fibonacci retracement from the previous swing high of the quote unquote, the real downward move, right, to here. Oh, this is going to work perfect. And boom, the overlap. And I looked for the 618 Fibonacci retracement to overlap with the 1618 Fibonacci inversion to be right at a level of structure. By the way, if you're not doing it already, make sure you check out the daily shorts that I upload to the channel. They're packed with quick trading tips that are easy to consume and are a great way to shorten your learning curve when it comes to trading. All right, let's hop back into the charts. And don't worry, I haven't forgotten. In just a few minutes, I'm going to show you how you can still get involved with this move, because there is plenty of opportunity still left on the table. Real quick, spoke about this earlier, but how about this pain-free trade, right? Pound yen going up to our 127, stopping right on a dime and turning around. So at this point, you're either looking for two things. You're either out of it for good and you're saying, hey, celebrate, let's make this money, baby, right? And buying all your friends' drinks and food at the bar. Or you're looking for the next opportunity to get involved, which if there is going to be a next opportunity, I would keep an eye on this level right here. I don't know if that's going to give us, I'm going to delete everything just because I'm getting confused now. I don't know if there's going to be a Fibonacci inversion deal here, but this would be that would be the level I would look for if you're looking, if you're either if you're looking to get re-involved or if you're someone that hasn't gotten involved yet. Keep an eye on that level, on that zone. This has the writings on the wall as one of those fake outs where it tricks us into thinking the trend is over when it gives us one of these things, but really it's not. And we can boom right back up. So keep an eye on this level for a secondary entry for this trading idea. So our Fibonacci inversion trade is working out well, but as I warned you in the first video, the last thing you want to do is get involved in the move late. That's where you become a sucker and you lose all your money. It's important to keep in mind that there's still a lot of room left for the second phase of this trade. Remember, our initial analysis had price action going up near this 219 even handle, and we're currently finding resistance at 218. So there's still about 100 pips to the upside. But what we want to do is we want to look for what's called a fresh break. And step one is going to be identifying our most recent level of structure, which is going to be our spike right here, the highest point that our trend came to before retracing. Step two is we want to wait for a break and close above that structure. So for price action to violate that level. Step three, and this would be my trading style, is to wait for the next pullback. So just as we did with the original trading idea where we broke structure and then we pulled back and then we looked for our reason to get long, we're just going to repeat that process here. So if we break and close, aka violate above our previous structure high, then that gives us a fresh break. That fresh break allows us to predict that price is likely to go higher. We already know where price is likely to go higher to, 219s. Now we're waiting for that pullback, getting involved at a cheaper price and looking to catch that next extension up. Remember this, technical analysis is only one piece of the trading puzzle. You can have the best strategy in the world, but if your psychology isn't under control, it won't matter. That's why I put together this playlist covering the mindset, the discipline, and the psychological skills that separate consistently profitable traders from everyone else. Go check it out, and I'll see you guys next video.